Hello and welcome to the DIY Investing YouTube channel. We are working through every company in S&P 500 and today is Equity Residential, ticker EQR. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. First up, we have a market cap of $23 billion, enterprise value of $30 billion. You see about $7 billion in net debt on this business. That's actually quite significant. You have about 25% of the enterprise value here as debt. It's not uncommon for a real estate investment trust, which is what this is, a REIT, as you might have heard of it. And so they are investing in real estate. It's common that those are very leveraged businesses. So their business description, they are focused on the acquisition, development, management of residential properties. That's a key part. Dynamic cities, high quality long-term rentals. So they have 305 properties, 78,000 apartment units, Boston, New York, Washington, D.C., Seattle, San Francisco, Southern California, and Denver. One thing that you would note about these cities, these are large cities and expensive cities in terms of cost of living. That should mean that they're probably pretty low on the return on invested capital numbers because they're probably going to be having to pay high numbers on the rent. Now the beta here, 0.83, not significant here. Return on invested capital chart. Now the first thing that leaps out to me on this chart is you have 20 straight years of profitability. Anytime I see that, I'm really impressed. I really like to see that. 20 straight years of profits means that there is a stable floor under which you're not following. As long as you're not losing money, as a business, it is harder to lose money as a shareholder, assuming you don't overpay for the stock. So this is a very good sign of a high quality business. However, you do have some signs of cyclicality here. These start to look like little waves and little cycles of business. Now, 2016 here looks like a one-off change that's not as different as it is here, but you do see clearly some up and down cycles in the business. Of course, peaking in 2005, going down 2008, 2009. This was a poor period for real estate, and then you've been recovering a little bit since then. Now, what's interesting about these numbers is that this is better than a lot of the real estate companies I've looked at in terms of, one, you're not losing money every year, and two, you are actually growing the real return on invested capital over time. You're getting up to the 6% number by 2021 when you're at 3% in 2017, 2018. So you are growing your return on invested capital. It's not staying super, super low. They have some nice returns there. They also have very strong free cash flow conversion from a 66% gross profit margin. So you like to see that as well. So okay business here, decent business. I like the high quality nature of not losing money, but the cyclicality is a little bit concerning. I also would really like this return on invested capital number to be above 10%, but it's not. And what you see here is they have used the debt to turn their 4.6% return on invested capital into an 8% return on equity. So that's a respectable number, but it does mean that you're unlikely to get double-digit returns for this investment if you hold this over the long term. Now, that might not be their goal, but you just need to be aware that kind of the upper end of what your investment will return over the long haul is going to be the return on equity. Now, this is the past return on equity. What matters is the future return on equity. If this trend line continues and return on invested capital eventually gets above 10%, you're going to start to see really, really attractive returns on equity, and your future could be a very attractive return. Now you see a PE ratio here of 20. I want to understand, is this earnings kind of out of step from the past? Is it overstated in any way? We see $3.54 here. You see $2.45, $2.60, $1.77, $1.63. None of that looks out of hand in terms of what those numbers are. So I'm going to say that that's not kind of off-putting. I would say this is probably a really accurate return PE number here. You do see pretty steep price sales EV, but that's not unheard of when you have such high margins. So I don't have a problem there. One thing to think about, though, is you have relatively low growth, 4.9% revenue growth. The key here is, why is it increasing over time return on invested capital? It's because you're growing your revenue faster than your assets. 4.9% revenue growth, 2.4% asset growth. If you do that over a long period of time, you're going to improve your return on invested capital. You like to see that. What I don't like seeing is that from 2013 to 2021, you're basically flat on revenue. You had $2.4 billion in revenue in 2013. You have $2.4 billion in revenue in 2021. So for an 8-year period, you didn't really grow your revenue. Now, you had some ups, you had some downs, but for the most part, you've not really gone anywhere. And when I think about holding an investment for the next 10 years, I really want it to be compounding. I really want it to be growing. And I don't see that growth here, and that's a big concern for me. I mean, not only is your revenue growth flat, your gross profit growth is flat, 1.5 billion, 1.5 billion. operating profit is up 20% from 500 million to 620 million. That's not a lot. That's like 2% a year, which is this, EPS 1.7% a year. So these are okay numbers, but you're really not growing that much. Part of it looks like is you're putting a lot of money out in dividends, being paid to shareholders, a very high payout ratio compared to your earnings. That's one reason that you might see that. Now, of course, it's a REIT, so you have to pay a large dividend. But again, it's just you're not getting a lot of growth. And so because you're not getting a lot of growth, you would really like higher returns on equity or a much cheaper price, and you're not really getting either of them. So this is kind of like in the middle in terms of what a potential investment might be. You really would want better returns, better valuation, and better growth. But none of them are terrible. They're just all slightly not as good as you'd like. If you're enjoying this video so far, hit that like button. Don't forget to subscribe. Those are the two best ways you can support this channel. So if you're a long-time listener, please do that. If you're new to the channel, please check it out. And at the end of this video, you're going to have a link to the best companies I have found in the S&P 500. Those are my watch list stocks. I hope you'll check those out. So income statement. See flat SG&A, that's a good sign. You like to see that they're not really growing their SG&A much. Because they're not growing their revenue much, you need to keep those costs under control. They've actually maintained their operating expenses under control very well, and that's been very profitable for them because of that. Now, one thing I want to look at here is just 2016. So again, this 2016 was this spike here to 19% return on invested capital. We want to check to see, is that a real number? What you can see is it is the peak in their operating profit. They did hit $1 billion in operating profit. Actually, no, that's 2016. 856. The big problem is you have $4 billion in non-operating income. What that simply means is that we should just write off this year as abnormal. It isn't a reasonable number to take into account. This net income is not normal. You should just expect it to be right in line with the next year. I mean, 2016, 2017, what did you earn in 2017? $1.63. That's probably what you earned in 2016 without those one-time items. So again, 2 or 3% return on invested capital. You got to ignore that spike. Anytime you have big one-time adjustments, you need to go investigate them. This is a really great tool, quickfs.net, in order to do that. If you'd like to check them out, free or paid account, first link in the description below. That's my affiliate link. I would appreciate you to use that link. Now, you do see some dilution here. They've diluted you by about 20%. So you've gone from 320 million shares outstanding to 388 million shares outstanding. That 20% dilution is going to cause about a 2% per year reduction in your return, which is a big problem because you're not actually growing that much. If you were growing quickly, then that would be one thing. But as we saw in 2012, you're at 500 million in operating profit. 2021, you're at 620 million in operating profit. You grew your operating profit by 20%. How much did you grow your shares outstanding? 20%. So 2% a year growth in operating profit, 2% a year growth in shares outstanding. You basically don't gain anything for the whole decade, and that's a major problem in terms of your potential to compound your investment as a shareholder. So again, as a shareholder, you can't compound unless the business compounds, and this business is not compounding. You do see some growth in assets. You've gone up about 20, 30, 20%. Okay, pretty much in line with that. One thing that I like here is your debt is actually down. So you've grown your assets, but your debt is down. That means that your equity has grown a little, which is a good sign. So you're actually a little bit better invested in the business, a little bit more margin of safety than you would have otherwise had. That's because they've taken the shareholders' equity from $6.2 billion up to almost $12 billion. So that is a good sign in how the balance sheet has been managed. Now, from the cash flow statement, I would assume this other is some sort of buying additional real estate or something along those lines, because they're not putting it into PP. They're not really putting it in acquisitions. So you have to assume that these numbers are kind of real estate transactions is how they're classifying this on here. What's nice is that they're not huge. They actually are investing lower than their cash flow from operations. And so you actually are, the company's being managed somewhat well. Other real estate companies, you might see much worse dilution. You've had relatively low dilution here, and it's because they're not trying to grow super rapidly more than their capabilities. They're trying to grow in line with their returns on assets, 4.9% revenue, 4.5% assets. That allows them to not have to dilute as much. That's a good sign for what the management is doing. However, it's just not enough to really offset the stock-based compensation. You see they're not able to do a lot of buybacks. They're not issuing a lot of stock here, but they are issuing through stock-based compensation, and they're not putting the money into the buybacks in order to prevent the dilution. That's really where you're going to get the dilution over time and really decay of your investment. When I look at this overall as a holistic look of equity residential, real estate investment trusts have this problem of low returns on equity, but they're actually managing that well because they're not growing super fast. And because they're allowing their revenue to grow faster than their assets, they are getting some better returns. The problem is this company is just average. You have an average, maybe an above average price. You have average, maybe sub average returns. You have average, maybe below average growth. And all of those things are just okay. I don't want to invest in an okay company, so for that reason, this company is not going to get on my watch list. If you're interested in okay companies, that's for you, but I really want to find something that's exceptional. It doesn't have to be exceptional in all three areas, but it would really need to be exceptional in at least one, hopefully good or better than above average in all the areas. And for me, doesn't hit it for equity residential, so I'm going to pass on EQR. If you enjoyed this video, hit that like button. Please subscribe. Your subscriptions and your likes are the best way to support this channel. And the third best way to support the channel is to sign up for quickfs.net through my affiliate link, first link in the description below. That's a great way to support the show. I'd appreciate if you do that. Until next time, stop paying fees, start building wealth.